Dobar dan svima.
Ladies and gentlemen, members of the press, members of the Council of the Governor of the National Bank of Serbia, dear colleagues, it is a pleasure for me to greet you on behalf of the National Bank of Serbia and welcome you to the presentation of the latest inflation report. Before I give the floor to Mr. Hinic, I will briefly present the contents of the inflation report and touch on macroeconomic developments last year and present our expectations for this year. Last year inflation was low, and since March it was moving below the lower bound of the target tolerance band. At the end of the year, inflation measured 1.7%. Such movements in inflation is a consequence of the sharp drop in prices of primary agricultural commodities and the consequent low-cost push pressure in the production of food, as well as a consequence of the absence of administered price growth and the sharp fall in oil prices. According to our projections, we expect low inflation. In January, inflation will be low and close to zero. From February, we expect inflation to start rising and to trend closer to the target midpoint in the second half of the year. And after that, inflation should stay within the target band of 4 plus minus 1.5%. Under our central projection, GDP will fall this year by around 1.8%, which is somewhat more favorable compared to our projection released in November 2014. This year, we expect economic activity to fall by 0.5%. On the production side, positive contribution to GDP will come from net exports and investment, while fiscal consolidation measures will lead to a drop in both private and government consumption. The recovery of economic activity is expected in the next year, while fiscal adjustment and structural reforms should provide a positive contribution to the rise in investments and net exports. The current account deficit amounted to 2 billion euros last year, which is equivalent to 5.9% of GDP. The current account deficit was somewhat lower than recorded in 2013. This year, we expect the reduction of external imbalances to continue, and we expect that the current account deficit will reach 4.3% of GDP. A contribution to the reduction in external imbalances should come from the recovery of the energy sector, from the low prices of import prices of energy, and from the reduced final consumption weighed down by fiscal consolidation, which should slow down imports. Thank you for your attention. Now I will give the floor to Mr. Hinic, who will present in detail the inflation report. Thank you. Ladies and gentlemen, esteemed members of the press and fellow economists, I wish you all welcome to the presentation of the February inflation report. This is the first time we meet in 2015, and I will use the opportunity to wish you success in your work and reporting on the National Bank of Serbia's activities. The prospects for inflation and economic activity have not changed from the time of our previous inflation report. Under the impact of temporary factors, year-on-year inflation continued to move below the lower bound of the target tolerance band. In fact, due to the high last year's base caused by the increase in the VAT rate, inflation is likely to have recorded a new historical low in January this year. However, it is expected to return within the target tolerance band around mid-year and to continue moving within the band thereafter. It is most likely that GDP will record a mild fall this year under the impact of additional fiscal consolidation measures and hence weaker final consumption of the household and government sectors. According to our estimates, the recovery of economic activity will start from 2016, given that consistent implementation of fiscal consolidation and structural reforms is expected to result in higher investment and net exports. Despite the negative effects of the flooding, the current account deficit continued to narrow down, from 6.1% in 2013 to 5.9% of GDP in 2014. In 2015, the current account deficit is expected to fall to 4.3% of GDP, led primarily by the effects of fiscal consolidation, the recovery of the energy sector, and lower import prices of energy. Developments in the international environment have been plagued by uncertainties associated with the pace of economic recovery, the effects of divergent monetary policies and unexpected moves of leading central banks, the movement in global oil prices, and the ongoing geopolitical tensions. Despite the sharp drop in oil prices, global growth is proceeding at a sluggish pace. An exception in this respect are the United States, that have experienced an economic rebound. Positive developments in the real sector encouraged the Fed to end the quantitative easing program and to announce the start of interest rate increases this year. Faced with deflationary pressures and languid economic recovery, the ECB increased to the utmost its reliance on unconventional monetary policy measures. It first expanded the program of purchasing private securities and then made a decision to engage in purchasing sovereign bonds of the euro area member states as well, thus coming close to the quantitative easing program implemented by the Fed. The ECB's asset purchase program aims to pump into the system over 100 billion euros by September 2016. The financial markets responded to the news by pushing down the yields on sovereign bonds of all member states of the euro area except Greece. Looking ahead, the divergence between the monetary policy implemented by the ECB and that implemented by the Fed is likely to extend the weakening of the euro. Faced with such outlook, after more than 3 years, the Swiss National Bank decided to remove the minimum exchange rate of the Swiss franc against the euro. The decision shook the financial markets globally, and in particular, the credit markets of some Central and East European countries, where a significant part of bank credit portfolios is denominated in the Swiss franc. The regulatory authorities in the affected countries are now looking for ways to relieve the borrowers' debt servicing burden caused by the franc's strengthening. In Serbia, Swiss franc loans account for around 3% of GDP, which is much less than in Poland, around 8%, and Croatia, around 7%, or formerly in Hungary, around 25%. As regards commodity markets, the decline in oil prices continued in the fourth quarter at an even faster pace than a quarter earlier. The price of oil plummeted in January to below $50 per barrel, which is less than half the price recorded in mid-2014. Considering that Serbia is a net importer of crude oil, a significant impact on foreign trade, inflation and economic activity may be expected if oil prices stay entrenched at low levels over an extended period of time. The above developments fed through into higher volatility in the international financial market and prompted investors to revisit their risk assessments. This dampened the capital inflows and increased the pressure on most emerging market currencies, the dinar included. Serbia's risk premium followed the regional dynamics and currently stands at 300 basis points. The demand for foreign exchange in the domestic market gathered pace in the fourth quarter, partly on account of increased payments of energy imports. The demand was also fueled by dividend payments to foreign owners, balancing of bank foreign currency positions, and net repayment of foreign debt by enterprises. All of this resulted in the prevalence of depreciation pressures. To ease excessive short-term volatility of the exchange rate, but without seeking to influence the exchange rate trend, the National Bank of Serbia intervened in the foreign exchange market by selling 765 million euros net in the fourth quarter of 2014 and 80 million euros net in the year to date. Though inflationary pressures were low, caution in monetary policy easing was commanded by heightened uncertainties in the international financial market in view of their impact on capital flows and the risk premium. The key policy rate was last cut in November by 50 basis points to 8%. Credit activity continued up in the fourth quarter on the back of the program of subsidized corporate lending, but at a weaker pace than in the previous quarter. However, as the program came to an end, credit activity will most likely continue to slow down this year, prompting the National Bank of Serbia to lower its foreign exchange reserve requirement ratios. The negative effects of the May floods on Serbia's economic activity are gradually fading. Despite the last year's decline, triggered mainly by the flood damage to the energy and mining sectors, the industrial production recovered in the fourth quarter, partly due to increased production in these sectors. This reflected on GDP growth in the fourth quarter, which, according to the National Bank of Serbia's estimate, equals 0.5% in seasonally adjusted terms. On the expenditure side, GDP growth was driven by more favorable trends in foreign trade. Domestic demand stagnated, the fall in investment and household consumption was offset by higher government consumption. In year-on-year terms, GDP fell by 1.6% in the fourth quarter, which is a significant slowdown relative to the previous quarter. In light of this, GDP is estimated to have fallen by around 1.8% in 2014. This year, GDP is expected to decline moderately by 0.5%. According to the Labor Force survey, the labor market continues to recover. The unemployment rate continued to fall, ending 2014 at 16.8%. A gradual rise in employment and real income of households in an environment of low inflation should contribute to growth in economic activity as of 2016. However, the strongest impetus to growth is expected from higher investment and net exports, owing primarily to progress in fiscal adjustment and structural reforms, as well as positive effects of external demand. Consistent with our expectations from the November inflation report, year-on-year inflation continued to move below the lower bound of the target tolerance band and reached 1.7% in December. At the same time, core inflation rose moderately and trended closer to the lower bound of the target tolerance band in December, aided inter alia by the past depreciation of the dinar. The undershooting of the target band during most of 2014 is largely attributable to factors with a temporary effect. The unexpectedly weak administered price growth and a sharp fall in primary agricultural commodity prices and global oil prices. On the other hand, the disinflationary pressures from low aggregate demand and low inflation in the international environment matched our earlier expectations. Under our central projection, year-on-year inflation is likely to return within the target tolerance band around mid-year and then move around the target until the end of the year. In addition to monetary policy measures already taken, such movements in inflation will be driven by the expected administered price adjustments, the effects of past depreciation of the dinar, and the gradual waning of the disinflationary pressures generated by primary agricultural commodity prices. On the other hand, price growth will be slowed down by low aggregate demand, its disinflationary effects reinforced by fiscal adjustment measures, and by low inflation in the international environment, which continues to run low irrespective of accommodative monetary policy measures. Inflation will stabilize within the target band also thanks to anchored inflation expectations. Owing to an extended period of low inflation and anticipation of weak inflationary pressures, both 1-year and 2-year ahead inflation expectations of financial and corporate sectors have been moving within the target band for the longest period on record.
Ovo je najduži period njihovog kretanja u tim granicama.
At its last meeting, the Executive Board of the National Bank of Serbia kept the key policy rate at 8%. In order to stabilize inflation at low levels in the long run, caution was exercised in the conduct of monetary policy, particularly in light of heightened geopolitical tensions and volatility in the international commodity and financial markets. These factors may result in increased investors' risk aversion, slower capital flows, and a more uncertain effect of monetary policy measures of advanced economies, notably those of the ECB, on the economic recovery of our key trade partners. Looking ahead, monetary policy easing will depend primarily on the assessment of the potential impact of developments in the international environment on capital flows and Serbia's risk premium, as well as on the movement in international and domestic prices of primary commodities and their effect on other prices. Fiscal consolidation measures, both taken and announced, have lessened the risks associated with fiscal policy. The initiated structural reforms and fiscal consolidation will reduce the external imbalance and facilitate the conduct of monetary policy, which is likely to contribute to long-term sustainable economic growth. Thank you for your attention.
Mr. Piaszczyk, could you interpret the story that we have just heard? Based on what factors will inflation increase and return within the target tolerance band? I understand the rationale behind it, but I believe that many people don't understand it very well. So, who will spend less and who will spend more? Thank you. As we have said, inflation is moving below the lower bound of the target tolerance band due to temporary factors, and these factors will gradually dissipate. I am referring primarily to the dissipation of the effects of the fall in prices of primary agricultural products and a lower disinflationary effect. And we also expect that the depreciation of the past period will yield its results, its effects, because the dinar depreciated by 5%, and this will spill over to prices. And the third factor that will impact on inflation is returning within the target tolerance band is the administered price adjustment. Let me remind you, last year there was no adjustment of administered prices, and we expect that this year adjustment of electricity prices will take place. We expect an increase of 15% movement, and we will have an increase in inflation by 0.75 percentage points, and this would push up directly inflation, and there are also indirect effects regarding the adjustment of other prices that incorporate the price of electricity. However, all this should ensure the return of inflation within the target tolerance band and its movement at around 4% by the end of the year. Yes, people have less money, and this is something that has slowed down the spillover of the effect of the exchange rate to prices, and due to reduced demand, traders adjusted to a lesser extent the prices of their import products at the expense of their margins, and this has slowed down the spillover of the exchange rate to prices, and this will certainly happen at one point in future. Thank you.
B92. I would like to use your expertise and to ask you about the launching of production capacities of the steel plant. What will be the consequences of the current plan of the government on the exchange rate, for example? It's hard to establish a direct link between the launching of the steel plant and the exchange rate movements. The moment when the steel plant is launched and its production capacities are launched, they should stabilize the exchange rate. But the exchange rate is already stable for the last 1 month. It's nominal. We have seen its nominal strengthening, so we cannot observe only one factor in an isolated manner and just one plant. But in any case, the activation of export capacities in this respect should stabilize the exchange rate because net exports should give a positive contribution to movements in the FX market. But what are the consequences? I gave the example of the exchange rate, but I believe that it will prop up GDP. Yes, to the extent in which the production of the steel plant increases compared to the last year, there will be some positive effects on GDP as well. But what is important is that our projections are for the time being, they for the time being exclude these positive effects in terms of an increase in production. This is a positive upside risk, which should slow down a decline in GDP. The moment when this is implemented, we will see the effects. Thank you. People who have loans in the Swiss franc say that they have continued talking to the National Bank of Serbia, and the central bank still offers 3 solutions, and this is not acceptable for them. Is there any progress in this regard, and what is going on this front? Negotiations are still ongoing with banks, and we have also consultations with the Association of Serbian Banks. I would just like to ask you to go back to our topic because our colleagues are in charge of monetary policy. Any further questions? Zoran Danilovic from the Tanjug Agency. Mr. Pieszczyk, you are familiar with the announcements from the EU that the ECB will purchase shares of banks, and this is a huge amount in question, and I would like to ask you the following. What would be the effects on the domestic economy, on the exchange rate, and on some macroeconomic indicators? Thank you. In January, the ECB decided to, as of March, start purchasing securities of Eurozone member states. What is certain is that in this way, liquidity will be boosted in the international market, and the effects that we could feel relate primarily to the increase in demand for our export products. And the second channel is the availability of sources of funding for our banks and our enterprises, and this should in any case stabilize movements in the FX market. This should increase FX liquidity, and at the same time, this should contribute to the stabilization of movements in the FX market. Liquidity will be increased in the Eurozone market, and this will have a spillover effect to Serbia, not directly to our banks, but of course parents of our banks will have benefit from it, because a bulk of balance sheets of our banks is foreign-owned.
Gordana Filipovic, Bloomberg. I just wanted to ask, since the Fiscal Council estimated that there is fiscal risk from the strengthening of the dollar, how do you see this? How do you see the impact of the dollar on public finances and on the exchange rate until the end of the year? In 2011, from 2011 onwards, all euro bonds and government borrowing was actually denominated in the US dollar. After the sudden strengthening of the US dollar in the second half of the year, there has been an increase in dinar liabilities under those foreign currency euro bonds which were issued in the dollar. What we know is that in the nominal amount, the amount in the dollars of 8.6 billion in September increased to 8.7 billion in January this year. But when you calculate this to dinars, we're talking about a significantly higher increase from 805 billion to 940 billion, which increased the share of public debt in GDP by 5 percentage points. And this is definitely a risk that anybody who borrows in foreign currency assumes. So if there are no further questions, thank you for your attention.